Right, hello, Forex millionaires. This video is just to explain market structure. We were taught that we have three types of markets. We have the bullish market, which is the uptrend. We have the bearish market, which is the downtrend, and then we have the ranging market, which is also called consolidating market, which is also called sideways market. So I'm doing this video so I can be able to explain the difference between the three. The first thing you are seeing on the screen right now is the bullish market. So I told us in the message in the this thing that the bullish market is having a combination of higher highs and higher lows, meaning that the market is having a series of higher highs and then higher lows. Okay, I'm coming, please. I want to explain. What higher highs mean is that the market goes to an high like this, and then that is higher high, and then comes back down, which is higher low. Goes to an up high, means higher high, come back down, which is higher low. Goes up, which is higher high, come back down, which is higher low. Goes up, higher high, come back down, higher low. That's how the market will keep going, to show you that that is an uptrend. Because why? The market will keep going up. So the first high you see here, which is the higher high. Are you seeing your chart already? The first high you are seeing there is the higher high. Are you understanding? So the first high you are seeing, this high is what I'm talking about. This is the higher high. Then the market now came here. Sorry, I don't know how to use this thing. I'm still learning how to use this thing. So following the chart, please, I want you to be following this the way I'll be signaling them out. This first place you are seeing is the higher low. The market started from a low here. So the market started from a low until the market now came and got to this point and formed an high here. And then the market came back down and formed a low here. Till the market now went back up and formed an high here. Came back down, formed a low here, which is higher low. Went back up and formed an higher high here. Came back down and formed an higher low here. Then went up and formed an higher high here. The market came back down and formed an higher low. Then you see the market goes and form an higher high here. You see another higher low, another higher low, another higher high, another higher low. You see, that is how the market moves. Whenever you are talking about a trending market, because why? The market keep making series of moves. The first high must not be higher than the next high. You understand what I'm saying? The first high must not be higher than the next high. That's when you know that you are still in an uptrend. The first high must not be higher than the second high, meaning that this first high you are seeing here, by the time the market come and form a low and then wants to form a new high, so this high here must not be higher than this previous high. They can only be at the same level, but they cannot be. If they want to, they can only be at the same level, but they cannot be at the first high must not, the previous high must not be higher than the next high. Because why? We are in an uptrend, so the market tends to behave according to whatever we tell the market to do. You understand what I'm saying? Now let me I think I'll be able to explain what an uptrend is. So an uptrend is comprises of higher high and higher lows, higher highs and higher lows. That's what you see in an uptrend. Okay, so how do we trade an uptrend? You buy at the low and then you sell at the high. I'm going to be making a video on that soon. Now the next market, this is a bullish market. Remember, in a bullish market, which is an uptrend, you have higher highs and higher lows. Meaning that the market is going upwards. So as it's going upwards, you just step back down a bit and then continues back upward, so that people that could not buy it from the start can be able to buy it whenever the thing comes back down again. Now let's go, you are going to understand it. Let's go to the next market, which is bearish market. You can see according to this chart here that bearish market is a downtrend. Okay, in the bearish market we have lower highs and then lower low. You see the difference between the bearish market and bullish market is that in the bearish market, the highs of the bearish market are coming downwards. I don't know, maybe you understand. The highs of the they are all pointing downwards. Even though the market will go up in a bearish market, it will still be a low. Because why? Now look, you will understand what I'm saying. Now in a bearish market, we have lower highs and lower lows. Lower highs and lower low. I'm marking them with LH and LL. Whenever I see LL means lower low. Just like the way I signal that in the bullish market too. So meaning that the high, the first high, which is the lower high, this lower high here, it must not be higher than the next lower high. And it must not be higher than the next lower high. It must not be higher than the next lower high. That's because it will be descending, it will be coming down. That's when you know that this is a bearish market. Because why? The market is just coming down. The market is coming down. Instead of things to be going up, it's coming down. That's when you know that you are in a bearish market. So now, and that's the same thing with the lower lows. You understand what I'm saying? I'm just giving us a brief understanding of what the market structure is. So in a bullish market, we have the higher highs, and in a bullish market we have the higher highs and the higher lows. In the bullish market we have the higher highs and higher low, while in the bearish market we have the lower highs and lower low. Now let's go to the next market, which is the ranging market. I taught us about the ranging market. Part of things. So a ranging market, I said, is a sideways market. The market is just playing within 2 points, within a support and a resistance. See the market just playing within this place, within the support and then within the resistance. Playing within the support, and then it gets to resistance and then come back down. It will go up from here. Whenever I reach that resistance, it will come back down. When it go up from you come back to down to the support. That's how you keep playing. Remember, we said there are two strategies to trade support and resistance. There are two strategies in trading support and resistance. How to trade support and resistance? Okay, we said we trade either you trade the bounce. It's either you trade the bounce, or you trade the break. Sorry, I'm just everywhere done dirty. It's either you trade the bounce or you trade the break. I'm going to be making sure that we all understand what we are learning. I'm just giving us a brief understanding of the whole thing. So, but then I trust that we are going to understand. So now there are two ways of trading support and resistance. We trade the bounce and then we can trade the break. So remember, support and resistance, they are the what we trade in the ranging market. Also in the bullish market and the trending market, there are support and resistance there too. You understand what I'm saying? But just that we are calling our support and resistance, we call them higher highs and higher lows. In the bullish market, in a trending market, you will call them the higher highs and you call them the higher lows. Why? Because they are doing the work there. Because the market is playing from one place to the other. Imagine in the bullish market now, this is your support. Wherever the market starts from, this is the support. As it got back here, this is your resistance. And then it came back and got to this higher low. Your higher low becomes your support. It goes up to this higher high. Your higher high becomes your resistance. So now let me give you one theology, one perspective that I used to and I explain to my students. Support is like a floor. Support is like a floor, while resistance is like a ceiling. I don't know, maybe you understand what I'm saying. Support is like a floor, while resistance is like a ceiling. Imagine you enter into your room and then you are bouncing ball. You just carry ball and then you bounce it from the ground, on your tiles. You bounce it and then what happens? The thing will just, if you bounce it very well, to go from the tiles and then to go to the ceiling. You understand what I'm saying? So it will go from the tiles to go to the ceiling. So what happened there is that the floor served as a support. So it was the floor that supported the ball to go up. The moment it got back, when it got up, the ceiling will push it back down. So the ceiling is like a resistance. I don't know, maybe you understand that analogy. So I think that will be all for this video. I will be making a next video telling us how to trade support and resistance. Thank you.